If I told you that you had only one financial decision left to make in your entire investing lifetime, a single definitive transaction that must secure your capital, ensure the preservation of your purchasing power, and generate life-changing returns for the coming decade, what would that transaction be? This is not a hypothetical thought experiment designed to test psychological biases. This is the reality we must confront as the global financial system accelerates toward an unprecedented inflection point. We are rapidly approaching the moment where decades of monetary malfeasance, coupled with unchecked fiscal expansion, converge into a crisis of confidence. The year is 2026. Why 2026? Because by that time, the lag effect of the radical policy decisions made between 2020 and 2024 will have fully materialized in the real economy. The quantitative easing programs, the astronomical expansion of the M2 money supply, measures that were initially dismissed as temporary fixes, are etching permanent structural damages into the foundation of global finance. When I look at the economic landscape, the sheer scale of the debt overhang is paralyzing. We are talking about sovereign debt levels in the G7 that are unserviceable under any reasonable interest rate scenario. The only path forward for governments is the continuation of currency debasement, a hidden tax on savings, designed to inflate away the real value of the obligations. This is the crucial backdrop against which any wise investment must be made. If you are positioned merely for growth or continuation of the status quo, you are fundamentally exposing yourself to the destruction of capital. My thesis, therefore, is rooted in scarcity, tangible assets, and asymmetric risk-reward profiles, assets that perform precisely when faith in central banks collapses. If I had that one singular chance, that one final bullet in the investment chamber, I wouldn't choose a single stock, no matter how promising the technology. Individual equities carry specific execution risks, management risks, and cyclical vulnerabilities. To secure comprehensive safety and maximum leverage in a collapsing fiat environment, the vehicle must be diversified yet highly specialized, liquid yet backed by physical reality. The answer lies in exchange-traded funds, but not the widely publicized ETFs tracking the broad indices or the speculative sectors. We are looking for three specific ETFs, representing three distinct pillars of financial insulation and leverage, which will serve as the indispensable bedrock of any serious portfolio by 2026. Let us dissect the current predicament further. The primary conflict facing the contemporary investor is the disconnect between asset prices and underlying value. We have witnessed a period where narratives, momentum, technological disruption, perpetual low interest rates have trumped intrinsic worth. Yet, we are exiting that paradigm. We are entering an era defined by commodity shortages, supply chain fractures, rising geopolitical tensions, and ultimately, a severe, persistent inflationary regime that central banks cannot tame without crashing the entire leveraged structure. They are caught between the Scylla of inflation and the Charybdis of deflationary collapse, driven by debt default. Their inevitable choice will be inflation, disguised by endless money printing. This context establishes the core conflict, the failure of paper promises. My choice, the three ETFs, are not standard holdings. They represent a deep value rotation, a monumental shift in capital from the abstract back to the physical. They are strategically positioned to capture the immense value gap created by years of systematic underinvestment in the real economy, specifically in hard assets and the companies that pull them from the ground. The first essential realization is that precious metals are not merely investments, they are monetary insurance. For decades, the true price of gold and especially silver has been suppressed, arguably through coordinated efforts in the derivatives markets, to maintain the facade of dollar stability and control inflation expectations. However, the physical reality is beginning to break through the paper armor. The drain on COMEX inventories, the increasing difficulty in sourcing substantial physical bars, and the massive accumulation by Eastern central banks, particularly China and Russia, are clear indicators that the long-term holders recognize the coming shift. Consider the dynamic leading up to 2026. The world needs to rebuild aging infrastructure and transition to decentralized energy systems, requiring colossal quantities of base metals, rare earth elements, and industrial components. Simultaneously, the financial system is undergoing maximal stress. What single asset benefits disproportionately from both industrial necessity and financial instability? Silver. Silver possesses a dual role. It is both a critical industrial metal, essential for solar panels, 5G technology, and electric vehicles, and a traditional monetary metal, often called poor man's gold. The supply-demand imbalance in silver is dramatically more acute than in gold. The amount of above-ground, investment-grade silver is diminishing rapidly, consumed by industry and not recycled effectively due to its wide dispersion across high-tech products. The industrial demand alone is soaking up a significant percentage of annual mine supply. When you layer monetary demand on top of this structural deficit, the price leverage becomes exponential. This leads us to the first pillar of my essential triad of ETFs. The selection must maximize exposure to this leverage. We cannot simply buy a physical silver ETF that tracks the spot price. While safe, it lacks the necessary convexity. To capture the highest asymmetric upside, the first foundational investment must be focused on the companies that extract silver. Therefore, the first ETF is one dedicated exclusively to junior silver miners. Why junior miners and not the senior producers? Because junior miners offer maximum optionality and leverage to the rising price of the underlying commodity. When silver moves from $25 to $50, a senior producer's profitability may double. However, a junior miner, whose projects were previously uneconomical at $25, suddenly sees the net present value of its future cash flows multiply by 5 or even 10 times. Their stock prices, which are essentially options on the rising metal price, experience massive percentage increases as they cross the threshold of economic viability. These stocks are currently trading at generational lows relative to the price of the metal, reflecting general market apathy and years of capital starvation in the exploration sector. The exploration pipeline for high-grade silver deposits has been severely neglected. The supply response to a spike in prices will be slow, laborious, and insufficient, creating a multi-year boom for existing proven reserves held by these junior entities. The ideal ETF in this category focuses on physical silver exposure, strong balance sheets, and management teams with a proven track record of discovery and operation in politically safe jurisdictions. This provides liquidity and diversification across the most volatile, yet most rewarding segment of the precious metals market. Now let us turn to the second pillar. While silver offers the explosive leverage, we cannot ignore the fundamental store of value that provides stability during systemic chaos. That, of course, is gold. Gold's primary function in the portfolio is the preservation of capital during the collapse of confidence in paper assets. Its intrinsic value is recognized universally, transcending national borders and political ideologies. Unlike paper currency, it cannot be created by decree. Unlike bonds, it does not represent someone else's liability. Its price movement is inversely correlated to real interest rates and the trust in fiat systems. As governments continue down the path of financial repression, keeping nominal rates low while allowing inflation to erode the value of savings, real interest rates plunge deeper into negative territory, which is the historical catalyst for parabolic moves in gold. By 2026, I anticipate that the market will finally abandon the delusion that inflation is transitory and that the Federal Reserve can simultaneously execute quantitative tightening and maintain financial stability. The pivot will be messy, marked by a massive surge in sovereign bond yields, or yield curve control, which is functionally even more inflationary, and widespread asset liquidation in over-leveraged sectors. In that scenario, liquidity will flee debt and equity markets and seek refuge in the only truly liquid, globally accepted, unencumbered reserve asset, gold. Therefore, the second ETF must focus on securing maximum unencumbered physical gold exposure. We are not interested in synthetic products, derivatives, or ETFs that use futures contracts. We are looking for the absolute purest expression of physical gold ownership, held outside the banking system and vaulted securely. The importance of this distinction cannot be overstated. In times of extreme financial distress, counterparty risk becomes the primary threat. An ETF that represents fractional ownership of allocated, auditable physical metal offers the necessary protection. The specific choice here involves a vehicle known for its transparency, its high percentage of allocated gold, and its mechanism for converting shares directly into physical bullion if necessary. It must stand as a fortress against the coming financial turbulence. While the return profile might not be as explosive as the junior silver miners, its role is utterly critical to maintain the base purchasing power of the capital, acting as the stabilizing force that underpins the aggressive leverage provided by the first choice. Let me stress this point. The current pricing models for gold are fundamentally flawed because they do not account for the sheer size of the fiat money supply chasing a finite physical asset. The monetary base has grown exponentially, yet gold's price increase has been suppressed by various financial mechanisms. As these mechanisms fail, as the physical settlement demands overwhelm the paper market, the convergence of price will be sharp and violent. By 2026, the re-rating of gold, based on its true purchasing power relative to the exploded monetary base, will be well underway. Positioning early in a purely physical ETF is mandatory. So far, we have established two pillars: high-octane leverage, junior silver miners, and absolute capital preservation, physical gold. But if I only had one chance, I couldn't stop there. The biggest mistake investors make when seeking safety is focusing exclusively on the past. The future requires a third crucial component, an investment that insulates against global supply chain shock while participating in the undeniable energy transition imperative. This brings us to the most overlooked and perhaps the most complex sector, one that offers a unique hybrid profile combining industrial necessity, geopolitical strategic value, and structural supply deficits that dwarf even the deficits in silver. This is the investment that acts as the necessary pattern interrupt in our defensive strategy. It's not strictly a precious metal, but its scarcity and essential role make it a hard asset play of equal importance. The world is shifting from fossil fuels to electrification. This transition is not debatable. It is a fixed engineering and political imperative. However, this shift requires massive inputs of specific, strategically vital minerals. Minerals often mined in geopolitically challenging regions, requiring immense capital expenditures, and suffering from years of market neglect similar to silver. These materials are the indispensable catalysts for battery technology, high-strength alloys, and the transmission infrastructure itself. My third and final ETF choice must capture the coming explosion in demand for critical energy transition materials. This includes, but is not limited to, copper, nickel, cobalt, and lithium. Copper, often referred to as Dr. Copper because of its historical insight into economic health, is now facing a supply cliff. Every electric vehicle requires exponentially more copper than a traditional internal combustion engine vehicle. Every gigawatt of new renewable energy capacity demands thousands of tons of copper and other specialty materials. Mining companies have not invested sufficiently to meet this incoming tsunami of demand. Lead times for new, large-scale copper mines are measured in decades, not years. The global copper inventory is at historical lows, yet demand is accelerating. This structural mismatch guarantees a massive, sustained price surge for these materials. The ideal ETF in this category is not concentrated in one metal but diversified across a basket of the most essential materials, and critically, the minerals that extract them. Similar to the junior silver miners, the leverage derived from owning the mining companies is superior to merely owning the metal spot price. When the price of copper moves past its threshold for profitability, the valuation of the miner with vast reserves explodes upward. This ETF provides a diversified shield against the risk inherent in any single commodity or country, ensuring that we benefit from the overarching global trend towards electrification and infrastructure rebuilding, regardless of which specific metal achieves the highest growth rate. Therefore, if I had one chance, one transaction to define my financial survival and prosperity through the volatility leading up to 2026 and beyond, I would allocate capital across these three distinct pillars. 1. A high-leverage ETF targeting junior silver miners, maximizing optionality on the dual industrial monetary squeeze. 2. A pure allocated ETF for physical gold, providing absolute insurance against fiat systemic failure. 3. a diversified ETF focused on critical energy transition material miners, capitalizing on the inevitable supply crunch driven by global infrastructure needs. These three selections represent the ultimate synthesis of safety and leveraged growth in a world defined by monetary instability and commodity scarcity. They are positioned to thrive not despite the financial collapse, but because of it. They represent real assets, real value, and a return to fundamental economic principles. The time to position is now, while these sectors remain relatively ignored by the broader market that is still mesmerized by the phantom profits of the previous cycle. This is the ultimate contrarian position, backed by centuries of monetary history and undeniable physical reality. We have established the macro environment, the need for tangible assets, and the three distinct categories that Eric Sprott believes are mandatory for survival and staggering returns by 2026. The next step is to drill down into the specifics, the exact mechanisms of these ETFs, the precise criteria for their selection, and the ticker symbols themselves that represent this ultimate definitive three-pronged investment strategy. The preparation is complete. The stage is set for the reveal. Do not miss the critical discussion on the structural details and the final tickers. I left you hanging in the last discussion, right on the precipice, standing exactly where Eric Sprott often positions himself, staring into the abyss of unsustainable debt and monetary recklessness, yet simultaneously recognizing the single greatest opportunity for wealth preservation and generation the modern era might ever witness. This is not about marginal gains. This is about asymmetrical returns born out of systemic failure, a failure that, by 2026, Sprott believes will be undeniable, unmasking the charade of solvency that currently holds global markets together. The premise is stark. If you have only one bullet left in the financial chamber, one chance to secure your future against the inevitable hyperinflationary fallout, where do you point that muzzle? We know the general direction: precious metals. But the exact vehicle, the three specific ETFs Sprott would choose, that is the difference between surviving the storm and capitalizing monumentally on its chaos. The foundational principle, the second hook that locks us into this mindset, is the absolute certainty of the central banking pivot. Forget the current rhetoric of higher for longer. That is a political necessity, not an economic reality. The debt burden across sovereign nations is now so vast that attempting to service it at genuinely restrictive interest rates, say 5% or higher for a sustained period, is a mathematical impossibility. It guarantees default, either soft or hard. Since governments inherently choose the path of maximum political convenience, the only viable exit strategy from this debt trap is the mass destruction of currency purchasing power through aggressive, continuous money printing. This liquidity injection, this quantitative easing on steroids, is the specific catalyst that will launch precious metals into their parabolic phase. By 2026, the pivot won't be a possibility. It will be an established emergency policy, and assets that cannot be printed will explode in nominal value. This brings us to the first crucial choice, the bedrock of the entire strategy, and the first ETF on Sprott's hypothetical list. Remember, he is not just buying exposure. He is buying leverage to monetary inflation at the cheapest possible point in the cycle. The immediate temptation is to buy physical gold ETFs like GLD or IAU. But Sprott is an investor obsessed with leverage. Physical gold is essential, yes, but it offers only one-to-one returns against the metal price. The gold miners, however, offer a historically discounted call option on the future price of gold. If gold moves up 10%, the miners, due to fixed costs of production or all-in sustaining costs, AISC, should theoretically see profit margins move up by 30% or 40%, generating 3 or 4 times the leverage. Therefore, the first selection is an ETF focused on the large and mid-tier established gold producers. Think of funds that track the senior index, perhaps a proxy for GDX or GDXJ, but with an emphasis on companies that exhibit high free cash flow yields even at current, depressed valuations, coupled with low debt and robust reserve growth. These are the companies that possess established infrastructure, proven management, and critically, operational scale. Why start here? Because this group acts as the anchor. They are the least speculative, the most liquid, and they provide immediate, amplified exposure to the rising gold price without the existential risk inherent in the pure exploration phase. Right now, the valuation disconnect is staggering. Many established miners are trading at price-to-cash flow ratios typically reserved for failing industrials, not for companies producing a critical, non-reproducible asset during a currency crisis. As gold inevitably breaches significant psychological and technical thresholds, $2,500, then $3,000, these majors will transition from deep value plays to cash printing machines. Their capacity to rapidly increase dividends, initiate share buybacks, and, most importantly, finance necessary expansion or acquisitions is what makes them mandatory for the foundation of this triple threat portfolio. This first ETF is Sprott's hedge against utter systemic collapse, wrapped in a high leverage mechanism. If the first ETF represents the calculated, disciplined leverage on monetary fear, the second ETF represents the absolute acceleration pedal on that fear. This is the pure high beta play, silver. Silver, often referred to as poor man's gold, is fundamentally different because it has a dual identity. Approximately half of silver demand is industrial, used in solar panels, electronics, and batteries, meaning it benefits from technological progression and global growth. The other half is monetary investment demand. When the world recognizes the necessity of precious metals, silver performs its historical function as the ultimate leveraged trade. If gold is heading toward $5,000, $10,000, or beyond, silver has the potential to move exponentially higher, fueled by two interconnected drivers. First, the gold-to-silver ratio, GSR, which currently sits far above its historical average, around 15:1 to 31, is heavily skewed. When fear peaks and money seeks safe haven, that ratio typically compresses dramatically. Secondly, the physical silver market is much smaller and less liquid than the gold market. A relatively small influx of institutional money or retail panic buying can drastically affect its price. Sprott's choice here would be an ETF focused specifically on silver miners, a proxy for funds like SIL or SELJ. This sector carries higher risk than gold miners because silver deposits are generally smaller, the extraction process can be more complex, and operating margins are tighter when silver prices are low. But this risk is exactly why they are mandatory in a high-conviction, one-chance portfolio. If the price of silver doubles, the operational leverage in a silver miner is often much higher than in a gold miner. A marginal increase in the price of silver can flip a junior explorer from being perpetually starved for capital to suddenly generating explosive free cash flow. We are talking about potential 10-to-1 leverage in terms of profit growth relative to the commodity price movement. By 2026, assuming the inflationary pressures are raging, the silver complex will be responding with extreme violence, making this second ETF the critical component for maximizing returns during the panic phase. This is where the massive, life-changing money is generated, provided one can stomach the volatility inherent in this sector. This selection demonstrates Sprott's belief that passive safety is not the goal. Aggressive positioning for a monetary paradigm shift is the goal. We have established the foundation, major gold producers, and the accelerator, silver miners. Both offer exceptional operational leverage compared to merely holding the physical metal. But if Eric Sprott truly has only one chance, the strategy cannot be merely tactical. It must capture the ultimate asymmetrical opportunity, the point of maximum inefficiency and maximum potential return. This brings us to the necessary pivot, the re-engagement that sets the stage for the true climax of the strategy. It is crucial to understand that Sprott views these first two ETFs as insurance policies that generate substantial returns. But the third ETF is the pure call option, the bet that delivers returns measured not in percentages, but in multiples. The vast majority of investors stop at GDX and SIL, comfortable with the liquidity and the established names. But if the goal is to fully capitalize on the commodity boom that inevitably follows catastrophic monetary policy, you must venture where capital fears to tread today, the exploration and junior development sector. The third ETF is the high-risk, high-reward component that fundamentally separates a good return from an exponential return. This choice targets the true junior exploration and development companies, the ones currently valued mostly by the cash in their treasury and the promise of a drill hole. This is the ultimate contrarian position, acknowledging that the entire resource sector is cyclic, and right now, the early-stage developers are trading at near-record low valuations relative to the commodity price potential. Why are these juniors the most potent play? Two main reasons tied directly to the future environment of 2026. First, scarcity and M&A dynamics. Major mining companies, the firms in the first ETF, are constantly depleting their reserves. They cannot print gold or silver. They must find it or buy it. Exploration is expensive and risky. When gold and silver prices soar, as Sprott predicts for 2026, the majors suddenly become flush with cash and face immense pressure to replace reserves. It becomes economically cheaper and strategically necessary for them to acquire successful junior developers than to undertake costly, multi-year exploration themselves. When a major buys a successful junior, the acquisition premium is often 50%, 100%, or even 200% above the prevailing market price. This third ETF, holding a basket of these potential takeover targets, is essentially a portfolio of highly leveraged call options on corporate activity driven by desperation. Second, extreme price elasticity. These small-cap companies have tiny market capitalizations and low share float. When the commodity mania hits full stride, when retail investors, mutual funds, and generalist funds pour into the sector seeking leverage, these low-float stocks are the first to experience dramatic supply-demand imbalances. A small amount of buying pressure can lead to astronomical price spikes. The leverage here isn't just operational leverage, AISC versus selling price. It's structural and market leverage where the market cap can quintuple based on a modest discovery or a rumor of a merger. Therefore, the third ETF Sprott would buy is one focused on the smaller, high-quality, geographically diverse precious metals exploration and development companies. Funds specifically designed to capture the junior development cycle, the ultimate leverage play in the sector. The strategy hinges on timing the market sentiment perfectly. Today, these juniors are starved for capital and trading near decade lows. By 2026, when the monetary failure is obvious and the price of gold is accelerating past $3,000, this third ETF will be the ultimate benefactor. It is the highest risk component, but in a one-chance scenario, it is mandatory because it offers the necessary, disproportionate returns required to overcome generational wealth destruction caused by fiat currency collapse. By selecting these three specific ETFs, the major producers, safety and scale leverage, the silver miners, high beta leverage, and the junior explorers, structural M&A and elasticity leverage, Sprott constructs a perfectly diversified, yet highly focused portfolio designed to maximize leverage across every dimension of the precious metals market cycle. This is not diversification against volatility. This is diversification of leverage. The confluence of events that makes 2026 the target year is the culmination of our entire analysis. It is the point where the inevitable central bank pivot has been executed, the resulting inflation is embedded in the system, and mainstream capital, having suffered massive losses in traditional bond and equity markets, finally rushes headlong into the only assets that have historically survived monetary annihilation. That sudden, desperate rush is what fuels the parabolic spike that these three leveraged ETFs are perfectly structured to capture. This conviction, this ultimate strategic blueprint, summarizes the enduring legacy of Eric Sprott's market view. It is an indictment of the current financial system and a blueprint for exploiting its predictable demise. If you believe, as Sprott does, that the currency devaluation is inevitable, then the time for cautious dabbling is over. The requirement is absolute conviction and the strategic deployment of capital into the most leveraged vehicles available. The three ETFs represent the optimal combination of stability, aggressive beta exposure, and pure speculation on the acquisition cycle, providing a complete, self-contained mechanism for capitalizing on the coming monetary reset. Do not wait for the confirmation. Do not wait for the news headlines to scream about hyperinflation. By the time the general public recognizes the problem, the greatest gains will already have been captured by those who positioned themselves ahead of the curve. The current depressed valuations in the mining sector are the gift being offered by consensus skepticism. Take the time, study the underlying holdings of high-quality ETFs in these three specific sectors, understand the mechanics of operational leverage, and position defensively, aggressively, and now. The clock is ticking toward the date when the central banks must choose inflation over solvency. Your future depends on anticipating that moment.